As we delve into the intricacies of the banking sector, it becomes evident that 2024 is shaping up to be a year of financial turbulence. The sudden and unexplained closure of credit card accounts by Bank of America raises questions about the industry's stability and transparency, leaving customers perplexed and frustrated. Yet, this unsettling development may just be the tip of the iceberg, as financial analysts predict a challenging landscape ahead. Amidst these ominous signs, the Federal Reserve's stance on interest rates adds another layer of complexity. Investors, once optimistic about rate cuts, now face a more restrained outlook. The possibility of a recession looms large, and JPMorgan's chief market strategist, Marko Kolanovic, warns of a catch-22 situation where market declines may precede any easing of monetary conditions. Let's dive in. Bank of America leaving credit card holders out in the cold. Bank of America has left its credit card holders unsettled, indicating a heightened scrutiny of the delicate balance between deposits and loans within the banking sector. On November 25th, the US Sun reported a disconcerting incident involving Bank of America abruptly closing a woman named Jessica's credit card accounts without any apparent reason. Despite being a loyal customer for 2 decades and maintaining a flawless payment record, Jessica found herself in a perplexing situation as all her credit cards were summarily cancelled without prior warning. Expressing her frustration, Jessica revealed, with not so much as a message in the app, a phone call, an email warning, they cancelled every single credit card that I have with them. Following a frantic call to the bank, Jessica discovered that Bank of America had reviewed all her other cards and made the decision to shut down the accounts, leaving her questioning the authority the bank wielded in cancelling all her credit cards without notification. Outraged by this unexpected turn of events, Jessica shared her grievances with her followers, stating, "I've got nothing left to lose, guys. I was already hungry, but thank you, Bank of America, for making sure that I'd be starving." In a similar incident just a week later, another Bank of America customer faced the perplexity of their credit cards being abruptly closed. This customer, with an almost perfect FICO score and a single missed payment 6 years prior, recounted receiving a notice without any specific details on why their credit cards, held for over a decade, were suddenly closed. Despite seeking clarification from customer service, the bank provided no explanation, leaving the customer to note that another institution had run their credit report the day before Bank of America made the decision to close the cards. More financial institutions are closing customer credit card accounts without providing adequate explanations. The banking sector is increasingly under scrutiny due to undisclosed regulations, resulting in sudden disruptions for account holders, often shrouded in mystery. The recent decision by Bank of America to curtail lines of credit has drawn attention and fueled speculation about a potentially significant issue within the broader banking sector. The widespread reduction of credit lines hints at a larger development or challenge facing the industry. This trend aligns with predictions made by financial analysts foreseeing heightened difficulty in accessing credit in 2024. S&P Global Ratings, in their Global Credit Outlook for 2024, emphasized the need for borrowers across all asset classes to adapt to tighter financing conditions and softer economic growth. While the specifics remain elusive, the report indicates that financing conditions are expected to remain tight in real terms throughout 2024. Borrowers have adjusted near-term maturities, yet the surge in speculative-grade debt coming due in 2025 makes 2024 a pivotal year. Anticipated defaults are projected to rise to 5% in the US and 3.75% in Europe, surpassing long-term historical trends. In addition to the overall credit landscape, Senior Director Teresa Pais-Fredel highlights challenges for US banks. They face the dilemma of adjusting deposit rates amidst growing demand for higher yields and increased competition from alternative high-yielding avenues like money market funds. Higher interest rates are expected to cool loan demand, weaken borrower repayment capacity, and lead to elevated impairments and credit costs. Fredel emphasizes the need for vigilance in monitoring credit loss trends in 2024. The resilience seen so far is unlikely to persist into the next year, resulting in higher delinquencies and charge-offs, particularly concerning our credit cards and auto loans, which may experience deterioration beyond historical levels amid expectations of a weaker economy in 2024. This is going to get even worse because no one knows when interest rates are going to start easing. So, banks are likely not going to have any push to get less lenient with credit. The Feds are not taking their crazy rates away anytime soon. Investors are reining in their expectations for interest rate cuts this year, a shift triggered by sobering economic data and cautionary statements from central bank officials. The exuberance that characterized the market late last year is being tempered. In the swaps markets, traders are now betting on a more conservative scenario of 5 or 6 quarter-point rate cuts by the Federal Reserve throughout the year, a slight pullback from the initial projection of 6 or 7 cuts. The market is currently indicating a 75% chance of the first cut occurring in March, a revision from the fully priced-in expectation at the close of the previous year. This more cautious stance on rate cuts coincides with unexpectedly robust US jobs data, which has weakened the argument for the Federal Reserve to initiate rate cuts in the near future. The minutes from the Fed's recent policy meeting, released on Wednesday, portrayed a more hawkish outlook compared to Chair Jay Powell's comments during the accompanying press conference. Florian Ilpo, the head of the macro at Lombard Odier, remarked, "The latest jobs report is the one piece of data we were missing to see markets show some moderation." He highlighted that after the Fed's recent monetary policy meeting, the anticipation of rate cuts had surged beyond what the Fed was actually communicating. In the closing weeks of 2023, investors had significantly increased bets on swift rate cuts by central banks on both sides of the Atlantic, fueling the most substantial 2-month global bond rally in several years. However, the likelihood of the Fed delivering numerous rate cuts this year appears slim. Simultaneously, JPMorgan is cautioning investors about a major issue of concern. JPMorgan sends out strong warning. As per a report from Yahoo Finance, analysts from the largest bank in the United States are sounding a fresh warning to investors. JPMorgan's chief market strategist, Marko Kolanovic, in a recent communication to clients, anticipates a decline in growth, signaling a potential recession that could adversely affect US equities. Kolanovic argues that the US markets are caught in a challenging catch-22 situation. He posits that the Federal Reserve might refrain from lowering interest rates until investors witness further market declines. In his own words, Kolanovic elucidates, "This is a catch-22 situation. This would imply that we would need to first see some market declines and volatility during 2024 before easing of monetary conditions and a more sustainable rally." JPMorgan analysts, as conveyed by Yahoo Finance anchor Shiana Smith, hold the view that stocks may be on the brink of significantly underperforming cash. Smith underscores Kolanovic's bearish outlook, citing limited upside expectations for equities in the upcoming year. With anticipated declining growth or a recession, Kolanovic suggests that this sector could lag behind cash by approximately 20%, signaling a considerable downside risk for the markets. Smith underscores the crucial role of the Federal Reserve as investors eagerly await signals of potential rate cuts. She observes a prevailing sense of optimism in the market, possibly overly aggressive in anticipating a rate cut as early as the first quarter of 2024. She remarks, "So when you take that into account and compare that to some of the more reserved expectations, there certainly is a wide variety of when that timeline is going to be. And also, not only that, but once the Fed does start cutting, how quickly then they will continue to cut is also obviously up for debate." Investors are closely monitoring the Federal Reserve, acknowledging the uncertainty surrounding the timeline and pace of potential rate adjustments. This comes as no surprise, considering that JPMorgan had issued multiple warnings last year about the stock market. The chief global equity strategist at JPMorgan Chase issued a cautionary note, suggesting that the robust rally observed in the US stock market during December is likely to lose momentum as 2024 unfolds. In his communication, Dubravko Lakos-Bujas outlined various economic challenges, encompassing slowing economic growth, diminishing household savings, and ongoing geopolitical turmoil. He highlighted that these factors have the potential to lead to a significant decline in the S&P 500 throughout 2024. The note emphasized the likelihood of a challenging macro environment for stocks, particularly if the Federal Reserve does not promptly implement easing measures. Lakos Bougias expressed worry about weakening consumer trends, especially in the absence of swift intervention by the Federal Reserve. In his written statement, Lakos Bougias remarked, "Without rapid Fed easing, we anticipate a more challenging macro backdrop for stocks in 2024, with softening consumer trends occurring at a time when investor positioning and sentiment have mostly reversed." JPMorgan strategists predicted an 8% decline in the benchmark index from its current levels, potentially reaching 4,200 by the end of 2024. This forecast differed significantly from projections by other major Wall Street firms, including Morgan Stanley's chief U.S. equity strategist, Michael Wilson, who anticipated the S&P 500 concluding 2024 at around 4,500. Despite contrasting views, Lakos Bougias emphasized the critical need for substantial monetary or fiscal policy support. He cautioned that current growth assumptions might be overly optimistic and unrealistic without such support. Remarkably, his assertions are proving true barely a week into the new year.